feel specifically about oil and gas industries, it's a very vast industry. It contains many relevant applicable application of relevant other provisions and other industry, which is always working along with the oil and gas industry. And if we look into the territory, it is also spread across the globe like that. So it is even we look into any company who are into oil and gas industry, they may have more connection or more activity even outside the territories of UAE. So I believe this is so much of interesting session to discuss. Nowadays, maybe we can also start with your views.
Right. See, first of all, we should know what is meant by oil and gas, and only then we will be able to analyze the taxability of it. Even before that, we should see how the VAT law is defining these oil and gas as. Even we have different kinds of energy, right? So, what is the taxability of it? How is it clear?
I think you may make it a little more louder.
Right. Okay. So even before we discuss about the taxability of particular transaction or the supply, we should know whether this particular item of oil and gas is treated as a goods or as a service. So we'll look into that first.
Exactly. The first point to look into the taxability, whether the supply is goods or services.
Right. So supply of all forms of energy, which includes the following. Otherwise, we will not be able to define it. We can't see something and we can't know whether it's a goods or service. But what the law says, we'll see any form of energy, including electricity, gas, and gas will have a lot of varieties. And certain people are attendees are from the industry. They might be knowing it, right? We have a lot of other types of gases and other oils. Gas, oil gas, liquefied LPGs, natural gases, a lot of different types of gases are there. What do you think? Whether it is goods or a service? As per the law is defining as all these items as goods and not a service. And hence, when we look into the taxability of particular transactions, we have to consider the place of supply rules of goods and not service. This is the basic point which we wanted to discuss always, because it's always confusing whether electricity is it a service or a goods. If it is not defined in the law, even we will be confused which stand we should be taking on. Where is it?
Exactly, and we would say actually that this is a special provision which have added into the law that which defines all forms of this energy as goods. So to avoid the confusion, make it more easier to adapt the tax treatments. I think that's a very important point related to these supplies.
Exactly. So this is the basic. And we have, let's say, when you take, as Ajay was mentioning initially, when we take the industry, it's not small. It's very vast. The kinds of operation that they have, the industry is having, the kinds of revenue that they are generating, and the complication it has, it's very humongous. So when we look into the revenue streams, we'll come to know what are all the just very few items I have listed down here for your understanding. Like the oil company might provide drilling services, seismic surveying, they will be doing geological surveys and all that. Then we have pipeline installation and maintenance, leasing of ships, storing and handling service at installations, refinery and warehousing services. As I said, this is very limited line items or revenue streams each and every oil company or gas company is having. The specific treatment for this one has to be looked into separately. Drilling services itself will have different components to it, or say seismic survey or any other service component if you look at it, will have its own tax treatment and should be looked into.
Exactly. Just to add on to or to connect with what you have just discussed before, these broad classification or the broad other services which you have just mentioned in this slide actually gives us the view really that it also includes, or when we think about oil and gas, we may have to think about real estate, we may have to think about uh, uh, installation services, we may have to think about transportation, we may have to think about shipment, and a lot of things which are associated with the oil and gas industry and which are very closely associated with it. So the treatment is, even though the prior sessions we have already discussed regarding the various industry, we would like to say that all those treatment is equally and always very closely applicable when we think about oil and gas industry.
Right. Since, as Ajal was mentioning, we have in the previous sessions have covered these items already. That it takes a week. All these points have been already covered and discussed in previous sessions. Then what makes it special when it comes to oil and gases? This one, the special applicability of this particular business. Why we wanted to discuss about the oil and gas sector.
The taxability, yes. The taxability, specifically Article 45, which is defining about the various supplies of goods or services which are treated in the zero rated. It have included a particular thing called supply of crude oil and natural gas. That makes it more interesting because it's not the whole industry, but a part of the industry is included into zero rated supply of crude oil and natural gas. As discussed in the previous slide, when we think about the industry consists of many other activities also, many other products also. So we have to actually see about an industry where there are certain supplies going into zero rated and at the same time many other supplies in standard rated. So that actually makes it more interesting.
Right. So the core income companies in this industry would be the supply of crude oil and natural gas, basically. And in that case, it is qualifying to be a zero rated supply. And one point which we wanted to highlight on this discussion is that we're not talking about we are only talking about the supply of crude oil and natural gas.
Yes.
Noise is coming in. Sorry. So we are now talking about the taxability of any other stream of revenue now, and we are concentrating on this part, supply of crude oil and natural gas. As Ajay was mentioning, oil and natural gas. Going forward, we will see there will be slight changes. Sometimes it will be 5%, sometimes it will be charge, and all that's still coming in upcoming slides.
Exactly. And anyway, let's move to the next slide. And at the same time, just want to give a note to the attendees actually that please do not get confused with the tax treatment because there are some special tax treatments in oil and gas industry. Even we started with because crude oil and natural gas where it is treated as zero rated and the other supplies are going to be standard rated. So there can be always a mix of treatment coming in. So maybe we have to be more, I would say, careful on the tax treatment when we look into oil and gas industry. And yes, now we are into how to charge VAT. So this is a very straightforward question: how to charge VAT. Normally, we as a supplier, who will charge VAT? The supplier, if he is a tax registered person, he will charge VAT. But the oil and gas industry is specifically with the related. Here, if you look into the supplier, the registered supplier is not actually charging VAT. It is the recipient of the goods who is actually responsible for the VAT application, and on that. So which we know the terminology because that is the reverse charge mechanism. We have discussed that with regard to import of goods or services. So same mechanism is applicable here. That makes this industry very special. You would say like that, isn't it, Navani?
True. Actually, the reverse charge mechanism we have seen in the cases of the supplier outside UAE, and you are bringing in goods to UAE. At that time, automatically it will come in the box number 6 through customs. We have seen in such scenarios. And when it comes to service part, okay, the foreign vendors are providing you services, and you have to account it under reverse charge mechanism. We are familiar with that. Other than these two scenarios, there are other two scenarios where the reverse charge mechanism will be applicable. One among it is the gold, supply of gold. B2B transactions are again, which we don't want to take up to current discussion. Now, supply of oil. But a registrant, a tax registrant, making a supply of these items to a registered person. We'll discuss the conditions, how it is reverse charge and which scenarios it is not reverse charge. Then the recipient is responsible, as Ajil was mentioned.
Let us move to the examples which actually will clarify the treatment. And we have actually considered this session with examples which actually will clarify the treatment. So here is our first example to begin with. And we have more examples today for discussion, so which will actually give you more clarity about the tax treatment. And the example here is with the ABC Petrochemical, one company in Fujairah, which is trading in refined oil. Received an order for AED 500,000 from the BP Petro Company in Abu Dhabi. So basically, they have received a normal order for supply of the refined oil, supply of the goods. So what would be the tax treatment? So as we know, the tax treatment, consider that the supply is of a taxable supply or a standard rate supply we are making, then that would be taxed at 5%. So if you on 5 million or 500,000, it will be 25,000 VAT amount. And most importantly, how it would be treated. So ABC Petrochemical is the supplier, but ABC Petrochemical is not charging VAT or will not send an invoice, a tax invoice with adding VAT. Instead, BP Petro, which is the recipient of who is also a tax registered person, who is actually accounting that under reverse charge mechanism. So this is very similar to what we normally consider for import. So same mechanism is applicable here. And I think more we may have to look into the conditions. What are the conditions required exactly to qualify this treatment? We may have to discuss more specifically on conditions, additional conditions, which are there in the coming examples. So maybe we can connect this example in the coming sessions also, coming discussion also.
Exactly. So just to add one more to what I was mentioning. So this transaction actually qualifies to be a reverse charge mechanism. And how we disclose it? We have to disclose it under box number 3 of the VAT return. At the same time, we are also eligible to take the credit for it, which we will take it up as per box number 10, just to add a point to that. Then we'll go to reverse charge mechanism, which is dealt in Article 48 of the law. We'll see the provisions first. Which are the products and goods considered to apply under reverse charge mechanism and how it is applicable, we will see.
Exactly, and I would like to add here at this point, because which are the products and goods here specifically to our oil and gas industry, which are the products applicable for reverse charge mechanism. So we are not talking, as we discussed, we are not talking about any other products or any other situation. We are talking about even in oil and gas industry, which are the products which has to be considered for reverse charge mechanism. You may have different additional products or maybe alternate products or end products even which is not considered in this list. So if there are such products you are dealing with in addition to the core goods which is defined here, then that will not be applicable under reverse charge mechanism. That would be under normal tax treatment. So in order to for that purpose, we have to see that these are the products in oil and gas industry which are qualifying for reverse certificates. As you can see in the slide, it is any crude or refined oil and unprocessed or processed natural gas or any hydrocarbons. And because when we define the product, so whether this product, the supply of the product always will qualify for a reversal mechanism treatment, or what is the further points that has to be considered by the supplier in order to decide that this supply is for reverse charge mechanism. That's we have to discuss now.
Yeah. So just to add on to that, like say these are all the products which are qualifying to be treated under reverse charge mechanism. But when we are selling to, as you know, the reverse charge mechanism in this case is both the supplier and the customer should be within the UAE territories. And at the same time, the recipient of these goods, the intention of them also has to be looked into. Whether it should either to resell the goods that they bought, or we discussed just now, crude oil, redefined oil, or it should be used to produce any kind of energy. Or let's say that, just to make it simple, they buy petroleum products, which is oil, and they use it to produce electricity, say for example, in that case. Or the buyer of these products are planning to resell it to another party. Only these two scenarios, only these two cases of transactions, the reverse charge mechanism will be applicable. Otherwise, it's going to be normal mechanism. So
yeah, and just to add on, like, because when we are discussing these two conditions, that reselling and we are also discussing about used to produce or distribute any form of energy. There was a previous situation where similar condition was used, which was in the designated zone treatment, where we have used same to treatment, but that was not for reversal mechanism. To consider that as an out of scope supply in designated zone, where again, so just I think this would be easy for you to relate. So here also we have the same situation, that the conditions are either it is used for a reselling or it is used for the production of or distribution of any other form of energy. So similar conditions. So just I thought to refresh it or connect it with the designated zone treatment.
Exactly. And one practical case to discuss on, if whenever, let's say, not it's the obligation as per the law to comply with the reverse charge mechanism, you might be asking, in that case, what if I charge overcharge? What if I charge on my invoice 5% VAT and issue a tax invoice and make the supply? Ultimately, government is getting. Actually, no. Practically, we had to undergo a case for one of our clients where they happened to take this particular stand. Later, FD got them, and they came back to us and said why they got. Then we had to represent, as Ajay also will be able to have more contributions to this discussion. But we had to represent, saying that okay, as per the law, this is the treatment, and you are required to comply. Instead, if you charge 5% VAT on the tax invoice and issue to customers, that will not be sufficient to comply with the requirements. Right. So to take it further, again, one more example to discuss to get it clear for you. ABC Petrochemical received an order to supply crude oil, coolants, and lubricants, multiple oil-related products. Accordingly, they have purchased the materials and delivered to a company. What will be the taxability of the supply? In this example, what we need to look into is two parts: whether all the products are qualifying to be a reverse charge mechanism product, or have to be charged with forward charge or not. The answer will be this way. For crude oil part, they have to treat it under reverse charge mechanism. Because as we said in Article 48 also defines that crude oil, redefined oil, all that will be, if you're selling to a registered party, here we assume that the parties are registered and they are intending to resell the product or use it for producing the energy. In that case, crude oil will be reverse charge mechanism, and other products which are not defined as per Article 40, you have to charge with 5% VAT on. It's the coolant and the lubricant.
Excellent. This was the thing which we were discussing in the beginning. So there can be two treatment. Even it's a part of one supply or part of one order, but two different tax rate is applicable, but two different tax treatment itself is can be applied because of the nature of the product. One the reverse charge mechanism and another under 5%. So this is the specialty which we are talking about in this industry.
Right. So going forward, the conditions to treat the transaction under reverse charge mechanism. First one, registered person. Should be a registrant, VAT registered person who is making the supply. Again, the person who is receiving the goods or to whom I am supplying also should be a registered person. These two are the basic conditions to treat all these transactions under reverse charge mechanism. One more additional requirement, which might not be seen in other cases, would be that we should get a declaration, written confirmation. Okay, that what they are intending to do with these particular items. Is it going to be for reselling or is it going to be for producing the energy?
Yes, with regard to registration, anyway, we are also like aware that because if the supplier is first of all, supplier has to be a taxable person in order to charge VAT. But the difference here is we normally does not look into whether the customer is actually registered person or not. But in order to apply reverse charge mechanism, so when we say the crude oil or the products defined, processed or processed natural gas, all those to apply under reverse charge mechanism, the supplier, it is the responsibility of the supplier. This is very important. The supplier has to ensure that the recipient is a registered person and has to get a confirmation, written confirmation from the customer that he is VAT registered person, and it is also the responsibility of the supplier to verify that. So even later, there should not be any case that supplier says that I was not aware about he was not registered, thought he would be registered, but the TRM which he gave, I thought it was correct. So there are various ways, maybe through the Federal Tax Authority website itself, you can verify the TRM number, whether it belongs to that company, or you can ask for the TRM certificate. So definitely the return confirmation. So this has to be received by the supplier before the date of supply. Then only in that transaction will go under the treatment of reverse charge mechanism. If not, how to charge VAT according to the tax rates.
So I think that's pretty clear to all of you now. Again, example. A company, FBC Petrochemicals, have received an order from Fuel Trading Company, which is a newly incorporated company, right? Designated on. Crude oil worth 300,000 is supplied initially. Fuel Trading Company have also supplied for VAT registration. What is the treatment to be followed by?
Yes, sir. Here, I think we can just connect to one type of transaction also, because the customer is now located in the designated zone. In our discussion before, we mentioned, or for the example purpose, where we are thinking about ABC Petrochemicals, which is located in Fujairah, which is located in UAE mainland. So sale is actually from UAE mainland to a designated zone, and where they have to see the normal tax rate. So if it is 0 rated or 5%, they have to charge. But here, the point whether they have to look into is if they are registered for VAT. Here, the example says that they have applied for VAT registration, so they have not obtained the VAT registration, and that written confirmation that VAT registration is obtained and they have the VAT TR number is not provided by the customer at the point of supply. Because of that reason, the tax treatment here is not under reverse charge mechanism, and they have to charge VAT 0 rated because this is crude oil. Crude oil have specific tax rate zero rated. So they have to charge VAT zero rated and not on the reversal mechanism.
Exactly. So one transaction based on the customers and how whether they are registered and their treatment, we have to decide our tax ability. So that's pretty clear to all of the attendees by now. This we discussed, like we have to get the confirmation, written confirmation from the customer that it's used. What is the intended use of this product, and only then we can decide on the taxability of it. And again, we're not discussing about export or indirect export of the oil or the crude oil or any other products. It's only the case or the mere case of where the supplier as well as the customers are within the region. Those cases we have the tax treatment for these cases only we have discussed now. Normal export or indirect export, which will always be zero rated, and the complications of reverse charge mechanism will not come into picture. Right. With one more example to discuss on, ABC Petrochemicals received an order from a company in KSA, is from Saudi, an implementing state, which worth 500,000 is to be supplied to KSA. ABC Petrochemicals arranges the export shipment and exports the goods to KSA. What will be the taxability of it? As we just discussed, it's like there is no RCM treatment because the customer KSA is not within the rates. Hence, it's always going to be a forward charge and it's at 0%. But again, if we do not have the documents, we are going back to the basics of export and documentation for that. If we don't have it, we have to charge with 5%. As simple as that.
Even because here, like when we think about that, here we can see different treatment can come based on the product nature, because it can be if mandatorily, because you when it is exported outside UAE, we say that it will not again qualify for reversal mechanism. So supplier has to charge VAT, and if it is qualifying as export, it is zero rated, because qualifying as export means we have to follow all the conditions that goods has to be moved out within 90 days. We should receive both official and commercial document of export. So everything has to be received. And if we do not receive both document, for example, we are receiving only the official document, but we couldn't get the commercial document, then it will not be again treated as an export. It will be treated as a local supply. At that point, you have to again look into whether your supply is crude oil or natural gas, which is qualifying for zero rated, or your product is the other category, which is standard rated. So basically, you can see the nature of the product actually changes your tax rate. So that's very interesting, and it has to be very carefully noted while choosing the tax rate and treating it during the transaction.
Exactly. So another example, ABC Petrochemical purchases from a supplier from Ajman. Even though both supplier and ABC are VAT registered, supplier charged VAT 5%. Is the treatment correct, and what are the additional actions required? Right.
And what are the additional actions? I think Navneet, here at this point, this was something very similar to what you have discussed before, and this actually gives the some more clear picture that the tax treatment of reversal mechanism is not mandatory application, because it is only can be applied if you satisfy all the conditions. So we should understand that supply is not default into reversal mechanism. The treatment of reversal mechanism can be applied only if the conditions are satisfied. So there is an option that if that conditions are not satisfied, then you may go into charging VAT 5%. It is always supplier's responsibility also. That also we have to be very careful, because to make sure that the registrant, the customer is a registrant person, and he is also using the goods for another resale or trade, further trade, or for manufacturing, which both of these things you have to get in their written confirmation. So these responsibilities are with the supplier. So that is the most important thing that we have to keep in mind when we look about the transaction. And I think this transaction will, or this example actually clarifies that particular point in this example.
Right. So as you was mentioning, since we have not obtained the declaration and the purchase is not for production or energy or resale, then we have to go for 5%. But again, case to case. In this case, it's a diesel, which is not a crude oil or refined oil, and that is qualifying to be taxed at 5%. Of course, it's like a forward charge. We have to issue an invoice, and the customer company can take the input credit and all that comes in the picture. So it's like a routine transaction, any other transaction. So to sum it up, I feel like I can put it this way: whether the product, we have to see whom we are selling and what is the intended use of these products. And then we have to decide whether the products are qualifying to be scale rated of 5%. And accordingly, we have to take it forward.
Right. Practically, we may just can discuss one more thing related to this, because normally when we think about VAT compliance, it's not only one party who have to do the VAT compliance. As a VAT registered person, we may be complying with VAT, but it's not only us. Maybe we have to look into whether our supplier or customer is also complying, or whether they are acting right with regard to that. Because in this example itself, because when we, as a supplier, you can see the responsibility of supplier is whether the customer is VAT registered, whether he is using for. So all these responsibility, whether he is also getting compliant with the provisions that we are looking into. And in this specific example here, you can see, even though, for example, if this ABC petrochemical might be ready to comply with the provision, might be ready to take it under reversal mechanism, but supplier here in Ajman does not look into that point. The supplier was not in a position about looking or getting the written confirmation, etc., before the date of supply. So the supplier has to charge 5% VAT. You can see that if both parties were aware about the law provision properly, and if they were adopting it on a same manner, then this would have been under reversal mechanism, where actually even the cash flow of that would be eliminated. So there would be advantage even on a cash flow basis as well. So I think that's also one important point. It's not only us, even whom we are dealing with also has to be aware about the tax provisions in order to have a comfortable VAT treatment. Maybe we can say the use itself, because there is a cash flow impact as well when we think about charging 5% and taking it under reversal mechanism.
Right.
Yes, here maybe we can go into another one example here. Again, connected to the previous things, but let us just analyze one example here. XYZ FZ is a company inside designated zone. So now we are talking about a company, for example, it might be in Jebel Ali Free Zone or Jafsa, for example, and it is providing equipments to oil companies. So it's a supplier normally providing equipments to oil company, and it also have an associated warehouse in Abu Dhabi. So this XYZ is having a warehouse in Abu Dhabi as well, and XYZ receives supply contract from the oil company in Abu Dhabi, and the equipment will be imported by the oil company, but need to deliver only on call basis. Again, we can look into one more thing, that because the oil company might be getting the benefit at the customs related to industrial license, etc., where there might be customs exempted, or they can receive customs rate reduction, etc. So there are the oil companies or the industries which might receive in customs. So they will not be ready to lose such benefits. So they will be always ready to import the goods in their customs code itself. So we can see in this example, the Abu Dhabi company, the oil company is importing the goods in their own name, their own customs code and TRN, and but the equipment will be kept in the warehouse. That's what we have to see, because need to be delivered only on call basis. So even though if it is imported to mainland, but it will be, if you see the remaining, the risk and responsibility is with XYZ facility till delivered to the site location. Imported equipment will be kept in the warehouse till delivery. So that means maybe if we just take an example, maybe 1st of Jan 2020, the goods might be imported, and the import might be done in the import code and GRN of the Abu Dhabi oil company. The goods will be in the Abu Dhabi warehouse, which is connected with XYZ FC. It will be at the warehouse, and it will be moved from the warehouse only on a call basis. So maybe in the month of March or April, the oil company is requesting to deliver this equipment. At that point only, they will deliver it into the oil company premises, and we can see the risk and responsibility still with the oil with the designated some company here. So, what would be the tax treatment? This is not just alone with the points of oil and gas tax treatment or the supply, whether reversal mechanism or zero rate. It also have the points we have to think related to the import of goods, whether that would become taxable, etc. This is what coming in my mind. Navneet, you maybe can add your thoughts into it.
Exactly. So when it comes to the tax treatment of these kind of transactions, and actually, if you look at it, these kind of transactions are very common when it comes to this particular industry, because the kind of machineries, capital equipments, and items that they actually require or procure in order to execute the job, whether before drilling or extraction or for supply or laying down the pipelines or let it be for any kind of, but it's humongous in nature. All the cases, they might not be purchasing it on their own. They might be leasing it out from different parties. We are closely related to different companies who are actually supplying the rotors and all this equipments, all the valves, and who is actually doing the geological survey. A lot of parties are coming together to execute the job or enable these oil companies to take up the job. And these leasing out transactions are very common in nature, especially as Ajul was also mentioning, due to the duty exemptions and refunds and discount policies available to these companies. Imports are generally happening in the name of oil companies, the leasing agents or the principals. So it's very interesting to look into these particular tax treatments, how it will come, whose book will come as RCM, and whose responsibilities will be enforced. We'll look into the answers to these questions now. Right. So basically, the XYZ is the company who is actually leasing out the particular material, even though it is coming in the name of the oil company, and they are actually required to issue a tax invoice with 5% VAT on. We are assuming that a leasing out transaction happening is a service element that is being involved and not the supply of material. That's very common. So whenever you look into the transactions, you have to look into the substance of if the tax treatment for the goods as well as the services are different. You have to look into that angle and determine the taxability of. In this case, we are leasing out transaction that is happening, and it's a service kind of transaction, and it's chargeable at 5% VAT. Right. What will be the treatment of both the import, which will automatically be coming in the box number 6 of the oil company who's actually. However, the risk or the responsibility, as mentioned in the previous slide, is to do with XYZ, not with the oil company. And hence, the oil company will have to reverse it under box number 7 because it's actually not there. And this has to be done under box number 7 of the XYZ and disclosed. But case to case, we have to analyze it. So this is a tricky area. It's not limited to oil companies. But we discussed this particular case especially because this is very common in the oil companies. If you are a contractor to an oil company or subcontractor to an oil company, you will have such kind of transactions and scenarios. That's why we wanted to take it up at this specific platform.
Exactly. And just to add one single point on which regarding to the risk and responsibility, because when we, if we look into the law, where the law defines the supply of goods, law specifically says that a goods is treated as supplied only when the receiver is getting the right to dispose it or getting the right to use it on his own. So here, when we discuss here the risk and responsibility still with the XYZ. So here that point is actually coming in where the ownership is not really transferred. So that's the very important thing which in any transaction we have to look into, because actual ownership, whether it is transferred, whether the recipient of the goods can take that goods as his own, he can dispose it or he can use it according to his convenience. So all those things we have to look into. As Navani said, we have to see into the actual essence of the transaction in order to decide whether there is a real supply of goods or it's only a temporary possession change alone. So we have to look into very specifically into this aspect.
Right. So with this, we conclude the examples, but we have additional points to discuss with respect to this particular industry. Certain points, let this be for the companies who are actually supplying to oil companies, and we have cases with oil companies as well. The first one will be with respect to submission of tax invoices. You're a contractor or you're a supplier to this company, and you have made a supply for which you have to submit or deliver the tax invoices. Now, if you look at the large-sized oil companies in the UAE, they have online portals where you need to upload these documents and get it approved. Most of the cases, we, a contractor, are unable to comply with the tax invoice requirements. Some cases with respect to the format of it, some cases with respect to the invoice date. We'll discuss it together. One more point: date of supply and date of tax invoice. Why this has been included? Let's say, for example, you supplied some materials to an oil company, and you need to issue a tax invoice within 14 days, unless it's a continuous supply, right? But you are able to issue an invoice only once it's been approved by the oil company. Even in some cases, the contract will be defined in that way, but general cases, if it's just delivery PO, LPO and delivery, then this kind of issues are happening where you are unable to issue the tax invoice within 14 days time frame due to the portal mechanisms and approval mechanisms laid on there. So we have to cautious on this part. You have to ensure from your side that you are preparing the invoice. But you have, since the oil companies are having a hole in some cases, you might have to adopt it. But you will have to attach the supportings to prove from your side you have complied with the requirement. These two are the practical difficulties which are faced by the companies who are supplying to the oil companies. A certain other transaction with respect to the companies who are into these industries, we collect, like we know, we supply gas in contained houses and for commercial purposes, and we collect the deposit for it. What would be the tax treatment for these transactions? Like any other deposit transaction, and you have to look into it that way only. It will not be treated as a taxable supply deposit amount unless it is adjusted against your future supplies. That has to be looked into. These are all very far-fetched examples that we are putting it down and not inclusive or existing. It has a lot of other components and elements and streams of revenue associated, as we discussed in the slides, just for the sake of the understanding how the treatment is difficult. And VAT treatment of repairs and maintenance.
Hello? Ravi? Hi, Ajay. believe there's some issue with your voice sound.
Disturbance is coming in.
Then clear?
Now
Yeah,
it's
now it's fine.
Yeah, fine. I'll try to keep it this way. Sorry for that. Right. So the treatment to determine the repairs and maintenance and where exactly it is taking place, it's complicated. It's not easy. It's not a straightforward answer. Okay, you can say that it's 5% of zero rated or out of scope. We will not be able to say that. We have to look into the transaction and determine on that. Do you have anything to add on?
Yeah, I think like rightly mentioned, even we may have to look into the place of supply, etc. Whether we have to see whether it is out of scope. There are a lot of things when we take up one-to-one point. There are a lot more to discuss. I think our discussion, and even practical difficulties, as we said, because in some cases even you may not be physically handing over the invoice or the document. So there are a lot of things when we look into practically and like to empty containers. There are transportation of empty containers which are also there. You might be making supply, but later the empty container is coming back. What would be the tax treatment in that? So normally we say it's an empty container is coming back. There will not be a tax treatment. But if you see practically, it can even cross the borders. It can even go back from UAE border to another country or from a designated zone to mainland. So which all actually create practically more things to see about the taxability, because practically each transaction or each case will have different tax treatment. Or even if we look into additional services like telecommunication services associated with the oil and gas, or the services which is provided on offshore or in the high seas, etc., which might be even outside UAE territory. So such kind of transactions we have to look into very specific. The excess supply rule is very much important when we think about oil and gas industry, because each transaction may get different from one side to another side itself because of the place of supply rules, etc. So I think it's more interesting when we look into each transaction to transaction. That's why I just feel to join.
And these are all the few additional points. Like, so we have just to put on like over and return swapping of crude oil arrangements. We make arrangements with other oil companies to trade the excess quantity, or I'll take the oil today and I'll give it back tomorrow. A lot of kind of arrangements are happening in the world of oil and gas industry. And as Azul was saying, we'll not be able to limit the discussion to 1 hour. Just to say why we had a session on oil and gas industry specifically is to discuss on the tax treatment of crude oil and redefined oils and natural gas, and whether it is zero rated or 5%, and to decide whether reverse charge mechanism will be applicable or not. And if reverse charge mechanism is applicable, what all the conditions to be satisfied, what all methodologies, what all things we have to look into beforehand. Just to discuss on this part, and not to discuss on the place of supply rules for the additional services like what is being laid down on the slide. I think with that we can conclude this. Anything point to add?
We may just look into the Q&A. I think because time is just getting over. Anyway, there's not much Q&A as now.
Hi, speakers.
Yes.
Before we go to the Q&A live, can I launch our poll so that we can have a feedback?
Yeah, maybe a quick poll you can have.
Yeah. Hello to all the viewers on the other end. Before we start our live questions, I've launched a poll on your screen. I request you everyone to poll this, and this will help us understand the feedback on today's session, and also it will give us an idea on if you require some services from us, because we're always there to support you. Yes, thank you. We can see it coming. Thank you. Great response. Thank you. Thank you. It's I'll be keeping this for 2 minutes. It's 48 seconds now. Okay. Thank you. I request more attendees to vote. I mean, to put the pollings. Okay, 10 more seconds. For all those who have already put your pollings, we thank you very much from the bottom of our hearts. And yes, thank you for being such a great audience. Here I am ending the poll.
Okay, thank you for the attendees. We are just looking into the Q&A, and I think it's not very specific related to oil and gas, but on a Q&A, one or two questions here, and from Mr. Maha. We have a question regarding to the treatment for designated zone to mainland. So this is related to import, or we, as we have, I think we have already covered this discussion, because we hard to see whether the ownership of the goods or this, in order to consider the tax treatment. But if it is an import by the mainland company, then that would be under the OSHA mechanism. So that actually depends on the nature of transaction. And I think there is one question, again, that's not specifically related to the oil and gas related. But again, export of goods, is it 5% or 0 rated? I think we have also defined that. If documents are not there and if it is not gone within 90 days, etc., then it will not be qualifying for 0 rated export goods. So has to be satisfied in order to be 0 rated.
Right. And Mr. Kraus, Muhyiddin has asked, Mr. Muhammad has asked another question, like it's not directly related to oil and gas, but since the relevant question I would like to answer, that we are perfume business and every month some perfumins get damaged or sometimes due to expensive disposal. Can you tell what is the VAT treatment? The VAT treatment is two perspectives. One is with respect to normal loss. Like say if it is a normal loss of your business, like on like when you do the business, you will have normal scrapping of materials. If it is that way, evaporation or that way, then the tax treatment for that. And actually you're disposing it off and we're writing it off from the books of accounts, the treatment for that is actually different. In the first case, VAT might not be applicable, you might not have to reverse input VAT, but you have to look into the transaction and the kind of amount that your the volume of the damage and determine it accordingly. The second scenario where it's an abnormal damage and writing it off, then we have to look into also the deemed supply provisions to determine the taxability of it. So straightforward, it will be 5% or it will be out of the scope. But damages can be two ways, abnormal and normal, and the treatment of also will vary industry to industry, because we have to look at the industry average also to determine the normal loss count. Every industry will have different loss percentage. If it is restaurant 33% or vegetable 40%, industry average we will have to look into and specifically analyze on this transaction. Can you explain about invoicing from contracting company to oil?
Yes. One more question from Shrikant, which is on the contract. Even though that's again to oil and gas company, but since the invoicing is from the contracting company, so contracting company has to look into what is the transaction which you're performing You have to look into the place of supply rules, whether it is within UAE or outside UAE, etc. as well. And if it is related to the real estate or related to site, etc. also. And considering that the tax treatment would be as normal in the contracting industry, it could be 5%, or if the place of supply is different, that may change. In the thing to add on into the treatment in contracting company?
No, just a basic treatment. General treatment you have to adopt. You have to prepare a tax invoice. Let it be a company of leasing to oil companies, or let it be a company of chemicals, or let it be any kind of transactions. Since you are not the oil and gas company and you're not supplying the crude oil or redefined oil, which as defined in the law, the normal laws of supply rules and taxability will be applicable to you as well. And I don't think we'll have to specifically look into it. Continuous supply regarding another question is from Mr. Mahesh. Then normal Article 26 provisions will have to look into it, and it can be summary tax invoice for the whole month if you are invoicing, or it could even be tax invoice on as terms based on the date of supply provisions. I think that would be it. We are actually running out of time. It's already past 9. All the other questions, please post to us as we always say, and we are open to answer all of your questions. And by then, I think we can conclude. Anything to add, Mr. Rajan?
Thank you very much, and thank you all the attendees for listening to us and for your Q&A, which we believe we could provide you some clarification on that. And let's all stay and continue our learning. That's what I would like to say.
Because it's the last day of our it's the last day of our VAT part, but we have ESR and other parties coming up, and other sessions also will be coming up soon. Thank you all attendees for being there for listen to us all the time. Thank you so much. Good night.
Thank you, everybody.